Yeah, the stock, the valuation of the stock in relationship to the company is an absolute farcical joke. If you believe
Yeah,
it's
of
worth
course.
anywhere near this, I got a bridge to sell you.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. Any references to performance of securities are thought to be materially accurate and actual performance may differ. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional.
And we are back with another edition of the Daily Dots. My voice is a little strained. I'm sure you can hear that. And it's not really the Dots. It's the weekly show, but kind of a combo today because of the interview that we just dropped. And I am joined, as always, by the Brain Trust himself. And also one of the reasons why I wanted to do this today is I did the interview by myself, and I was kind of excited to chat it up with Chase about it, to kind of share some of the stuff I heard. So I figured it'd be good listening, or hopefully anyway. And before we get all into that, why don't we give a little rundown of the indexes here today? Kind of feels like almost the mirror image of yesterday, kind of a flip reversal of almost just, you know what I mean? Just flipping the deck over. What are you seeing? Where are we at?
Yep, S&P. So we have like 2 minutes to go, but S&P is down 0.4. Q's flat. IWM up 0.4. Equal weight flat. Mag 7 down 0.33. All world ex-US up 0.6. So ex-US beating the US by a full percentage point, and that obviously is because the dollar down 0.5%. Although the dollar was worse off, kind of earlier in the day, and the rest of the world kind of held its water. Oil down another 2.3%, now $62. You have Bitcoin just above that 110 line still. Gold up 1.1, silver up 0.16, but the miners up, almost 3% today. In yield land, basically a big non-farm payroll move here with the 2-year down 7 basis points, and so is the 10-year. As far as Mag 7 went, it was kind of a weird day where you had Tesla up over 3.5, and then Google up 1, and then that was about it. Everything else was not great. Vol flat on the day. And one other thing maybe of note, China getting off the schneid a little bit with FXI up over 1% on the day. Kind of good day for obviously the rest of the world, but Asia in general. You had kind of think everything in Asia having a decent day.
Yeah, looking phenomenal. The Tesla one cracks me up on that tape. I mean, as always. So Tesla up 3.5% because the board announced $1 trillion pay package for Elon Musk. The one thing, maybe there was something else, I didn't see it. It's an incredible stock with incredible shareholders. That's the one thing I will say. I mean, to that point, it's really even hard to discern what the stock trades on. Like I would love to show you the financials and just sit down with somebody. It'd probably be best to do it with somebody that was kind of a neophyte, to the game, where you want to really blow their mind, walk them. You hear so many of these Tesla fans and say they don't even understand the business themselves, right? They don't. Some of them are thinking it's all robots. Some of them think that Tesla's still going to dominate in EVs. That stock is priced on a million things, and it's cash flow, it's fundamentals, and it's really the only thing that doesn't play a part.
Yeah, I looked up after seeing the $1 trillion thing and laughed about that. I had to look up the free cash flow from last year, and it was $3.8 billion.
And you've got a $1.1 trillion market cap on it.
Yeah. So if he gets that trillion, obviously they have to get like a $7 trillion market cap or something for him to get paid, and some other stuff. But it would just essentially be a giant wealth transfer from dumb people to Elon to get there, really.
The one thing I will say about it, though, is that now everybody bear with me and don't just turn off the show right when I say this. But it might be the most egregious pay plan that's actually worth it. Meaning, where would this stock be without the cult of personality that and not just cult of personality, but also what he's done. Meaning, the stock, the valuation of the stock in relationship to the company is an absolute farcical joke. If you believe it's worth anywhere near this, I got a bridge to sell you. I don't give a dang who you are, Ron Barron. I don't care who you are. It's nonsense. That being said, the only reason that company has a market cap, even in a zip codes, that it's Elon Musk, 100%. What he's done, the way he's managed expectations, his persona, his personality, and then also the way that the guy, like you and I have talked, the valuations have never made sense, and I'm not counting on them ever making sense. And so it will never be a conviction long in our books, ever. Not unless something's extraordinarily changed.
The guy's one of the best salesmen, showmen, and CEOs of all time. There's just no two ways.
100%. Yep.
And all so three, I mean it on the CEO part. I don't like Elon, but I mean it on the CEO part. Like he is a great CEO.
Yeah, and you may not like him, but I'll tell you what, the one thing I will say about him is that I've owned stock in a lot of other companies and really wished their CEOs would take a note or two out of his playbook. Now, I would prefer it to be, in my opinion, Elon is not a fraudulent guy. I don't believe he is. But what I do think is he really tight ropes that line. And I would want my CEO to be more tied to facts, to be more
right.
Living in the present, just personality wise, because I think it opens up really weird possibilities and massive volatility down the road, which I wouldn't want. But if there is a CEO out there worth $1 trillion pay package, it's him. Right. To that shareholder base, meaning, yeah. Well, I mean, look, if you've got to get to a point, where Tesla is going to live or die on its fundamental value picture, the stock's going to go down 80 to 90% from here. And at an 80 to 90% decline, I think it would probably still be by far the most expensive automobile producer. It would be. I mean, you'd be trading it. If you had a 90% decline right now, it'd be trading at 20 times earnings. And its earnings are negative. It'd be 20 times a year and a half ago's earnings, right? I mean, but yeah, it's just absurd. And to tell you the truth, I can't even track the narrative anymore. What is Tesla?
I don't know.
Is it a car company? I had another one. I had a great one the other day with a Tesla long. And he said to me, he goes, well, yeah, but Zach, you don't really understand. It's not really, and he's a great guy, one of my favorite clients, and he's made a ton of money on Tesla stock. But I couldn't help but laugh, and I even told him this. He goes, Zach, but it's really not an automobile company. It's an AI company. And I said, buddy, before they said that, it wasn't an automobile company. It was a tech company. It was a software company. It was a full self-driving company. It's a whatever it takes to attract the most amount of dumb money kind of company. That's what it is.
Right.
Right.
Like when he started buying Bitcoin, he did that before it was cool when Bitcoin was going up.
I know. I think they sold most of it already.
They did.
But
it's that's the point though. It was a fad and he jumped on it.
It's really wild. Now departing from that, I don't want to waste too much time on Tesla. Another really interesting anecdotal thing. And I think it kind of shines light on what an abnormal market this is. I find it really interesting that the gold oil ratio, Tobias Carlisle put this out on a tweet today, and he and I went back and forth on it a little bit. The gold oil ratio is like the highest on record, right? Gold in relationship to the price. Of course it is, right? You've got gold at 3,600,
right, of course.
Oil at 60. And his kind of thing was, what does that mean? And obviously what it points to on the face of it is that gold is way overpriced, right? here's the thing though. Then you flip around and look at gold to gold stock ratio, right? So the price of gold in relationship to gold companies and the price of their stocks, you're like at the 20th percentile range, right? Meaning you're in like the bottom 20%, like you're extraordinarily low on that basis. And he and I had a back and forth about that. And it really got me to thinking. And I sat there and I went, that is a huge historic spread. I get that the knee-jerk response would be that gold is overbought. But I think if you take two steps back in any context, or and look at it with a greater context or full context, I think what it suggests is that oil is wildly underpriced. I also think it.
Go ahead.
Well, I also think it reflects underlying massive changes in the economy and the way it works, right? The relationship between oil and gold. We've gotten so much more efficient at extracting oil. We have not gotten more efficient at extracting gold. And so I would expect that ratio to look different going forward, and to not really conform. But there's another thing that I realized, and I've realized it with several of our winners this year. I think that we're finally reaching a point where we're starting to see the flip side of all the idiocy and overvaluation and speculation in this market. Meaning, I think what we're starting to see is fundamental value opportunities that you never would have seen before, and a market too dumb and distracted to take advantage of them. And what I mean, and I'll throw a couple out there. The run in gold stocks this year. I mean, look, you can sit there and go, oh, Zach, you got hindsight on your hand. Look, something could have happened and the price of gold may not have played out the way it has this year. That's entirely possible. But you want to talk about a fat pitch coming into this year? You want to talk about risk reward that was just off the charts, that nobody, and you and I know, because we had the conversations with people, right? That nobody was paying attention to. We've seen it with uranium. We've seen it with oil. I think we saw it most recently with American Eagle, American Eagle. Meaning, I don't think, back up the truck 10 years ago, I don't think we would have ever seen an opportunity like American Eagle come across our plate. Now, I'm not trying to make this like be the stock of the decade. I'm not saying that. What I'm saying is, when you see an ad campaign that's that smart, that targeted, that gets that much, that creates that many waves, then you flip around and look at a company who in a market trading at 32 times is trading at 10 times earnings while paying you a 4.5% dividend, clean financials. And you're sitting there going, exactly what I remember what you said. Any positive inflection here and this stock's going to rip higher. And sure enough, we're sitting there a month and a half later, stock's up 80% from where we bought it. And like I said, it could have gone against us, but you and I have spotted several of these, and we keep spotting them, where the only thing you're worried about is you're kind of scratching your head going, that looks too good to be true. You know what I mean? And I going back and forth with Tobias and started thinking, I went, it makes sense. If stupidity and idiocy win long enough, then it's like the bug light, right? In the corner, it eventually attracts all the mosquitoes, and eventually the environment surrounding the fire, right? The fireplace where we're all sitting, it gets a lot more comfortable. All the mosquitoes are over there. And I kind of think that is played out. I also think, you and I were laughing about Google when we were talking about a not too distant conversation that happened on CNBC, where all these guys that are supposed to be pros are like dogging on Google. And you go back and listen to the argument, there's nothing fundamental. It was almost like they didn't even know anything about the company. All their analysis was purely based on the short-term price movements. So I kind of think we're entering that golden age where the idiocy has gotten so prevalent that if you're actually looking at the fundamentals, there's stuff everywhere.
Yeah, I mean, I agree. To me, coming into the year, China was the same kind of.
Yeah.
I never want to use the word easy, but like versus the expectations, like, just sort of obvious that it could work. And if you looked around and I mean, I wrote about it, and I think it was I put in my piece the picture of like 6 different economist covers that were bashing China within a 2-year stretch. Like I don't know. It's some every once in a while they just kind of make stuff obvious. Like that was one for me. Like so to your point, like yeah, if you're and it wasn't like just because people were negative. Like there was huge fundamental inflections. So sometimes you just get that bell ringing from the fundamentals and from the way everyone else is looking at it. Everyone's too busy looking at whatever's like shiny at the moment. So yeah.
Man, that's so true. And it's something again that we've talked about, and I know that we've incorporated it into our own investing process. And we're certainly not the first people to see it, but and we're not the first to comment on it, but it literally feels like it's getting more true by the day, where if you want good results, and the better the results you want or expect should be correlated to your timeline, meaning your time frame, right? Like, meaning I think the greatest advantage that every investor has right now, especially the home game guy, is to not be short-term focused, right? Like, and you can't be in this market, because to take advantage, those unbelievable value plays that we've benefited from this year, they're there because they're being priced incorrectly and or being completely ignored. And the tough thing about that is that is a perception issue, and it is impossible to judge when the public or the market perception is going to shift. But when it does shift, this market, unlike any other, when it finally does start pricing things in, it happens like that. And you don't get a chance to get in front of it. The risk you run is being early and sitting on a dead asset for a little while. The upside is when it gets re-rated, you can make 5 years of returns in 2 months,
Yeah. Yeah. I mean, I think back to Greece, like it was trading under 10 times earnings. Now it's up like 80% on the year, whatever it is. And so, yeah, I mean, that basically is 5 years of returns in 9 months of this year. And now you could have had to sit on it for a while at 9 times earnings or whatever, but I don't know. For me, I'm willing to sit in some stuff at 9 times earnings if I like the story.
Yeah. And that's again, one of the greatest reminders is that short-term P&L, your year-to-date numbers. That's just not the most important. I think our results bear that out, 100%, right? A lot of the stuff that drove our underperformance, we didn't have a bad year last year. We were up 16, but the things that drove our underperformance are the reason that we're, trashing the market this year. And I don't say that arrogantly at all. I've done this job too long to get arrogant. As a matter of fact, it makes me nervous to even talk about things that are working. Right. But yeah, no, it really is this fascinating dynamic where I think that reflexive aspect of the markets is ironically now what is bringing us great investment opportunities, as opposed to just making us bang our head against the wall. Google, and again, I'm fully aware that one-off exogenous things could have happened where it didn't play out this way. But Google was another one. You put, and we were pounding, you and I have both been huge fans. We were pounding on the table on Google probably 2 years ago. Right. But just a perfect example. I mean, you flip around, you look at a market that's up, 9, 10 on the year. Google's now up 23, 24, and it's still really cheap compared to its peers. Right. It's still really cheap. And how they got, it was funny talking to Brad today, and we'll move into that AI discussion about the interview that I did with Brad Sarsfield, who's on one of the heads of the AI team up there. And what they specialize in is security. So they're on the cutting edge of AI. And he goes, in some ways, we're on the cutting edge of the cutting edge, because the security needs with every new breakthrough that we have on the AI side, it brings up 100 new security concerns. But anyway, I was talking to him. We were going through the different companies and talking about kind of the landscape in AI. And, he works for Microsoft, and he brought up Google, and he's like, he goes, it's kind of funny. Like, he goes, Google just kind of got ignored through this whole thing, and he goes, a lot of the stuff that got us there, that got the ball rolling, was from them. And he goes, it's kind of funny how they got left out of it. And he and I have talked about it. And he goes, even internally at Microsoft, he goes, when we look at the arms race for AI, we feel very certain that Google's going to be one of the winners, you know, that they're, and we're trying to make sure we are too. But you know, that misperception. And then you were talking about that conversation we listened to or that you were listening to on CNBC a few months back, where they're all just dogging on Google. And I mean, I don't remember it. I didn't see it the way you did, but I got to believe it was just all anecdotally based on the price movement of the stock. I mean, I don't understand what you would have pointed to unless you believe that Chrome was a zero, which I never understood.
It was all the like, oh, well, their whole business is search, and search just got disrupted by AI, and search is going to die for them, so they're dead. That was essentially the story. So like,
remember
and even then you can go look and like, search was growing by like 9% year over year when they said it, like, and if you looked, you know, people were still using Google like Gemini more than they were using OpenAI. So like, it took 3 minutes of research to like realize that all of that was wrong. But to your point, like about price action, like it's really what this is. It's like at the end of the day, price wasn't going up, so people had to convince themselves of why without digging in. Like, and if you do that, like you get stuff wrong. Like, and sometimes you do the work and you're like, ooh, yeah, like, yeah, I see what people are looking at there. Like, this is gonna be a problem. But every once in a while you get to do the work on price down and you're like, wait, this should be fine. Or the opposite, you know? You may have something going up and you look into it and you're like, no.
That's such a good point, man. It makes me think about, and I've never actually talked about this out loud, but I don't know if you've got stuff like this, but there's a part of my investment process that that we talk about all the time, fundamentals, values, all that kind of stuff. But there's something I just realized, you said that, it made me realize something that I do internally. Whenever I'm researching a company and break down a stock, I typically get to the end of it. And this is typical. It's less common today for sure, but this is typical. It usually leaves me at a place after I've done my research and understand it, where I look at the price of the stock, and the price of the stock is uncomfortable. And what I mean it's uncomfortable is you look at it and you're like, man, that's a pretty clever way the market is priced that. I see where this upside is, and it's low enough to make it attractive, but it's high enough to where I'm worried, right? It's kind of right in there.
It's like a Vegas point spread.
Yeah, yes, yes, exactly. You're like, God dang it, that's right where I would have said it was too, you know?
Exactly. It happens to me all the time with football betting.
Yeah. And then you see these things where you go, wait a second, did I miss something? And you go back and you go, and that's always been the biggest winners, where you just go, yeah, the market's wrong. And you hate saying that out loud. It feels dangerous, but we've run into more of those in the last 2 years than at any time in my career.
Yeah, it's ripe field for picking the fruit of just wildly mispriced stuff to both sides. Like it should be a great field to go picking fruit for long short. It's just that you can't, like, the pain of getting the short side off by 2 months just crushes those guys that do that in the hedge fund, space. So really you have to just do it as sort of a basket of stocks that don't make sense on their price on the long only side with, little hedges here and there, but just you can't be like 50% short, 50% long or anything like that.
No. Well, and if you think about it, that approach doesn't make sense, because a long short portfolio is very much reliant on the market making sense. And yet we're sitting here saying that you've got these unbelievable opportunities that are only there because the market doesn't. And I remember for years, you and I would sit there and say, and I talked about Tobias Carlisle. I would talk to him, he and I spoke about this many times as well. But you had these people that were like, this market is so irrational, I am shorting that.
Yeah.
And you go, hold on. So it's going to start being rational the minute you lay your money down? You know what I mean? Like,
it's rigged. So you're long S&P futures, right?
Yeah, I'm shorting it because it's rigged and it only goes up. And you're like, I don't. That's not how you're supposed to play that game.
They're trying to give you free money if it's rigged to go get in there. Buy some
Yeah, yeah,
calls.
yeah. And to a certain extent, it is rigged. And I don't mean like it in a nefarious, but
No,
this like
we talked about it a lot.
Yeah, it's been turned into a utility. That being said, though, the flip side is those opportunities that I just don't think would exist if you didn't have a marketplace that was so fundamentally blind. Now, moving on to the AI stuff, because that was had a super interesting discussion, and I know one that you're really interested in. Couple things I was left with. People do not have, and I've said this before, but it just bears repeating. People do not understand, not even close to understand, the pace at which this is developing, and the pace at which it is happening, and the pace at which it's going to impact your daily lives. We are doubling the compute power every 2 to 3 months, or excuse me, 3 to 4 months. Here's something else that I hadn't thought about that kind of rocked my world a little bit. and I think that this is a perfect synopsis of this space and how you're going to have to really liberate your mind thinking about it. So the compute power keeps growing. One of the biggest reasons the compute power of these things keeps progressing so quickly is they are getting 2.5 to 3 times the compute power out of H100s than they were getting when they first came out. And the reason they're getting 2.5 to 3 times the compute out of the H100s is not because NVIDIA made any changes. It's because the LLMs are telling them how to run them more efficiently and how to sequence them. So the LLMs, so the chips that were needed to build the LLMs, those same LLMs are turning around and streamlining the way in which the chips function. So as great as those chips were out of the box, they're 2.5 to 3 times better now in terms of their productivity. And NVIDIA had nothing to do with it. Like, think about how crazy that is, right? Where we create something to create something, and then that final product that we created turned back around and made the thing that created it better. Like,
right. And there's an escape velocity to that whenever like robots start building robots,
right,
and stuff like that, where you get to this weird point where like all these like laws of economics that we're so accustomed to applying, like they get warped and they don't hold the way we're used to them holding, because we've never had, like artificial intelligence. So it's going to be interesting, very, very interesting.
It also, the other thing I was thinking about is it's going to change, and it already is changing the investing landscape in many different ways, but a way that I want to spend some time thinking about on our side as it relates to Bulwark and our investment team. We need to start looking at businesses or ideas that we thought were limited, stuff that we thought was attractive and had big potential, but was limited by the technology that we have today, that was limited by costs that we have today. We're going to start needing to look at those opportunities differently and probably assigning different timelines to that stuff. Because the other thing that I realized while I was talking to him is so many of the timelines, so much of the progression and the scale or the ramp, the trajectory that ideas fall, so much of that stuff is going to be massively condensed, and things are going to move so much faster. It's
one riff on that. It is, and this is like very interesting to think about to me. Obviously we have electricity as a major constraint to this growing. And interestingly, like we're going after and shutting down these like offshore wind projects and stuff. We probably need every electron we can get. What gets interesting is like, I mean, in America, we've had very cheap electricity because of the shale revolution and the gas that comes from that. If we have to take that and all of a sudden make our electricity a lot more expensive because of feeding AI, like what things work today for no other reason than they have cheap electricity, because it may get hurt, and a lot of that stuff can migrate to China because China's going to have cheap electricity. But then you may have a situation where this stuff gets so efficient, maybe it's 5-10 years from now, and by then you will have built some nukes and an insane amount of solar power and everything. So you may get this opposite scenario where like the power price goes spiraling out of control higher and then has a massive crash lower. So then you may get whipsawed into like everything that needs cheap power gets really hurt, and the next thing you know, power is borderline free, and like all technology like works exponentially.
The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. Any references to performance of securities are thought to be materially accurate, and actual performance may differ.
All right, little tech snafu there. Thank you, Riverside, our beloved recording app. I guess what do you call it? App, website, whatever.
That's
anyway.
Jim Rome would say whenever he had one of his guests or callers drop sniper.
Yeah. Hey, whatever happened to? Where did he go?
He was doing
Jim Rome.
I don't know now, but he was doing the like Fox Sports like TV / radio show or something there last I knew. But he's like, I don't want to talk about it. He's like old now, which is just weird because I grew up.
It's real. Yeah, same. It's strange to see those cats getting older. And the weird part is we don't. You know what I mean?
Exactly.
You and I haven't.
No, wait. I don't know what everyone else is up to.
Yep. I'm not getting gray. I'm getting frosted. Right. Anyway, but so back to our AI discussion before we got interrupted. Can't remember exactly where we were at. That took a little longer.
I was talking about the power aspect of it's currently making power go up a lot, which is going to be a weird constraint on a lot of other parts of the economy that I don't think people are thinking about right now, and then vice versa. Like it may make power super expensive for a while, but then if it gets way more efficient, then the next thing you know, power crashes.
I'll tell you what, I mean, everything I'm seeing happen on that side of things makes me more excited about North American nat gas.
Yeah. And the other thing I was talking about was solar. And I think we're going to need all that we can get as well. Obviously nuclear, same thing, but nuclear, you don't just build that overnight. So I think a lot of work has to get done by especially gas short term, but also solar, and not just US wide, but like globally.
The other really interesting part about this is going to be to watch what the application of AI can do to a lot of these things, right? So, for instance, you've got power issues, physics issues with solar that make it less efficient. I would expect AI to probably, I would expect in the next 2 years to see some serious changes in terms of the power outputs we can expect from things like solar, because I don't understand how AI will not make that better.
Right. I mean, yeah. We have no idea what's coming next with it, and it could be really special, really disruptive and scary in a lot of ways, but really special in some ways.
Yeah. All right. Here in closing, and we've kept you long enough, but what other things? The other thing, the jobs report today, big reaction out of the markets. Well, not that big, but markets clearly reacting in a dollar down. They're going to cut rates. Well, first of all, I know you looked through the jobs number, and you and I haven't even had a chance to discuss it at length. But what we have learned is that oftentimes the market response to news is not at all what it should be, or not at all in line with reality. What was your take on that jobs report today?
Yep. So the market is definitely right that it was bad report. But in some ways it wasn't like catastrophic, but the revisions weren't nearly as bad as last time. But you're just barely growing jobs right now. And like I talked about this on the show yesterday, kind of a jobs preview, to say like the number doesn't really matter because we don't know what's happening with population. So like focusing on the kind of the 3-month rolling one, focusing on wages, focusing on the unemployment rate, like those are the things that are going to matter. Things like hours, like and most of that stuff was weak. So I think it's fair to look at this as a weak report. At the same time, the establishment survey added a good bit of jobs. The median duration of people that are unemployed actually went down. So like there were a couple little pockets of decent news, but my favorite way of looking at it's called aggregate payrolls, and it takes the jobs number, it takes wages, and it takes hours, and it rolls all that into like one number, and that it's still strong. It's just still decent, I should say. That's still decent. Wages are still strong, but you definitely slowed down a lot in the last 2-3 months, and not just on the number, but kind of those internals. So not catastrophic, but you continue to slow. Demand for labor is bad. The one thing that is really bad is the unemployment rate for young people. Like that's actually pretty sketchy. Like you're at like 2016 levels for youth unemployment. Like recent grads aren't finding jobs and stuff.
I was just going to say this. So, and these are the things you really have to watch out for, because we are so used to a binary world where unemployment down is good, jobs numbers up, good, higher wages, good. My daughter was telling me about a good friend of hers that recently got a job at Chick-fil-A making $18 an hour. $18 an hour.
But if you think about the basket of goods that buys versus 10 years ago, I mean.
No, I get it. But even if you look at inflation numbers for 10 years ago, that wage number's nuts. That kid at Chick-fil-A in 2015, 2016, 2017, they were making 10 to 12 an hour, maybe. I mean, I don't know what it was back then, but I mean, it was massively lower than that. And the higher those wage numbers go, the more unemployment you're going to see, especially at the teen level. I mean, I don't know how companies are. The other thing is when you're seeing wages at this level at the same time AI is rolling out, if you were seeing AI being deployed in an environment, you would you'd prefer to see it at a lower wage. You know what I'm saying? Like where you look at a company today and divesting yourself of the liability of that employment is worth double what it was 8 years ago. Right?
Yeah.
Like meaning the money you will save on an hourly basis by replacing that human being with something, autonomous and the benefit of that is twice to you what it was 8 years ago. And
when you consider healthcare costs,
oh yeah.
That makes wage inflation look puny.
The employment picture as soon as, that's wild to even think about. It's also wild to think about the fact that prices haven't even gone up more. I mean, I guess they have. If you look at a McDonald's value meal, I guess it's probably risen at about the same pace that wages have, which makes sense. I mean, that's going to be
right.
By far their number one cost. But yeah, it just feels like this cycle that we've been on is really starting to get strained and stretched. And I'm not saying it's breaking, but I think it's in the process of morphing to some degree, if not breaking. I just don't understand how you can keep doing all this. What else do you see of interest out there?
Nothing really as far as that goes. I think obviously inflation next week is going to be really important. And I think so. If people remember last month, you had bad non-farm payrolls. We go pricing in a bunch of like cuts, and then CPI comes out hot and it kind of pulls it back. I think we're going to get that again, where non-farm payroll is like, ooh, that looks like a 50 basis point cut. That's scary. And then CPI comes out hot and everyone's like, wait a second. I think you're just going to, that tension between those two major data points are going to stay, because we're just in a stagflationary environment right now. There's no two ways about it.
And it's really, the way that data gets interpreted and discussed continues to amuse me. Like I want to look at people and go, guys, you're still looking at this through the framework of the last 30 years. We are not on a path back to 3% growth with 2% inflation. Like, forget about it, right? That ship has sailed. I am convinced that if you want at trend or above trend growth, There's no way you're doing it without substantially above trend inflation. I'm just convinced of that right now.
Yeah, other than some productivity, just mega boom or whatever. But yeah,
Right.
and we have to get
But
through.
even then,
Good.
Well, even then, I think of the modern role of central banks and the modern role of governments and their relationship to the underlying economy and markets. And, even if you get that productivity boom, if asset prices keep ascending, that may not do to the inflation side of things what we think it will, right? Because,
and plus,
the AI boom ain't going to hurt the 1%.
And if the AI boom's on the back of really expensive electricity, then it offsets itself in a lot of ways. So to go back,
right, to and it ain't hurting the 1%. I can tell you that. Not the majority of them.
I saw an interview on Forward Guidance, and the guy basically referred to the stock market as itself universal basic income, and it's not universal because not everyone owns stocks, but it is sort of its own like weird UBI at the moment. And he talked about it being a utility and stuff. It was like listening to myself.
Yeah, well, and there's obviously a lot of reasons for that, but for people that want to like push back on that narrative or push back on that premise that guy's got, that I know that you and I share, look at it this way. If you have a government that historically has been running deficits between 1.5% to 2.5%, okay, and now all of a sudden that number is 7 to 8% of GDP, right? And continuing to climb at that pace, you have to start thinking about things differently, because now the economy is going to reflect a guaranteed stream of capital that is magnitudes larger than that guaranteed stream of capital has ever been. And therefore the economy is going to function differently, and it's going to be it will probably continue to grow less volatile in terms of asset prices, and you would expect to see just a higher steady push on asset prices higher. Again, I there are other things in play, but I think again, I just don't think people appreciate those numbers enough, right? They just get thrown around by statistics. When your deficits go from averaging 1.5 to 2, and now you're at 7 to 8 and climbing, that's a lot. I mean, that is 3x the amount of guaranteed government spending flowing as a percentage of the economy than the economy has averaged forever.
And it's important
that
to
is going to change.
That is new money. Like that is the same thing as printing money whenever the government spends that deficit. And in that way, it's almost like this current big deficit is doing what everyone expected QE to do that it did not do, because QE does not create new money. But I remember when we launched QE, it was like, oh, we're going to get huge inflation, and we're going to get, and then you didn't get a big inflation. You did get some asset inflation, but now you're getting all that through money printing via fiscal, because it actually adds money.
QE is like a topical acne treatment, right? It's like a spot treatment. It only helps the people that already have assets, right? Because like you said, it's not new money. So the only way you benefit from QE is if you have a balance sheet that allows you to take on capital and you can borrow at those lower rates. As when the government, we all saw it through COVID, but when the government's, throwing fiscal around and everybody benefits. But you just play the QE game, and only the guys with the gold benefit. So no, that's a great point. I'm trying to think of anything else on earnings that we missed. I think we pretty much covered it this week.
Yeah, I think we're good.
Anyway. All right, you guys. Well, hey, have a great weekend. We will see you Monday. Plenty of stuff coming. Again, first 2-3 weeks of September, you never want to take your eyes off the market. We'll be surprised if we don't see some fireworks one way or the other, but we'll figure that out as we go. So anyway, have a great weekend. Wish us luck. The first game of the 5th grade football season kicks off on Saturday. and we can actually stream those games online. So, I mean, you could have a huge viewership for this thing.
Millions and billions.
Oh yeah. I mean, it's a big one. It's crosstown rival, man. This is a big deal in 5th grade football. So anyway, you guys have a wonderful weekend. We'll see you again see you again Monday. You're listening to the Know Your Risk podcast. Check out our social media sites. Google Know Your Risk podcast. Run it through YouTube. You find our video feeds and all that good stuff. Anyway, we'll see you Monday. You're listening to Know Your Risk podcast. Download and subscribe at knowyourriskpodcast.com.
Investment advice cannot be given without a client service agreement. Zach Abraham is an investment advisor representative of Trek Financial, an SEC registered investment advisor. Bulwark Capital Management is a marketing name only and does not carry a separate registration.